Ladies and gentlemen, good morning. As the title suggests, we have been very patient and we are very close to a major market top. As we all know, bull markets tend to die in euphoria, and we are about to get to that stage. We are now at 2500. Our measured targets are anywhere between 2515 and 2600. We have been in this channel since 2009, and we are about to complete the fifth wave of the fifth wave of the fifth wave in Elliott wave terms. And in English, it means that we are about to spike a top and get to levels which are completely irrational and unsustainable. If we very quickly try to have a look at a closer chart, we can see weekly divergences on the MACD. We can see that the market is pushing through the weekly Bollinger Bands. It is attacking the upper trend lines. We expect all these to be broken in the next couple of weeks. The targets really are anywhere between 25.20 and 25.50 for the next couple of weeks. If this lasts a month or more, we could even get up into the 25.70s to 25.90s. But that should be the end of the bull market, because risk reward is beginning to be slanted against any further gains, and we will now look at why that is. In any case, we are going to start selling all our long-term positions into the next 2 to 4 weeks as the price rips higher in a bout of unsustainable euphoria. For anyone who follows Elliott wave, you will know that the fifth wave and the first wave tend to echo each other. Where are we? Well, we think we are somewhere here. We are now breaking through into new highs, and we probably have 1, 2, 3, 4 weeks of higher prices. We should be basically going around 3 to 5% maximum from these breaks back into a very quick down move in the markets, which might take no more than a month to complete, as it did here. But it's a move which should take at least 7 to 10% off the value of the market. So you're talking about a 250 point move to the downside after it's completed the top, taking it back down to probably 2300. So we probably have between 2 and 4 weeks to dispose of all of our long-term assets and get short. Are there any spreads which are giving us indications that the market is about to turn? Well, yes and no. We have XLP, XLY now consolidating the break out of this downward trend channel, therefore, which indicated risk on, while the market is making new highs. That is a divergence. We are now waiting for this to break through the 200-day moving average and indicate our way upwards. If it now breaks down and makes new lows, we will be wrong, and we will admit that we are wrong, but this to us, for the time being, is a divergence. And here is XLY, so consumer discretionary, over SPY. It is making new lows, another indicator that all is not well with this market. If we have a look at when XLY peaked back in back in 2007, it peaked very early, and then it kept on going down, indicating that something was very badly wrong with the S&P. And when the S&P finally broke, it stabilized. But it was very much a leading indicator into the break in 2008 and 2009. And there again, it was very much a leading indicator in 2008, when it just managed to make keep these lows and indicate another trend up. It broke above the 200-day and started moving well before the market did. So XLY over SPY tends very much to be a leading indicator, and now it is actually telling us, having broken this trend line that it held all the way from 2009, that all is not well with the consumer, that something is very badly wrong, and this is a leading indicator that prices in SPY are about to turn and head lower. When will we know that the correction has started? Well, quite simply, when the SPY over TLT starts making new lows, when it breaks these levels, that will be a sure sign that we are about to make a very nasty move in SPY. We are still stuck in this range of uncertainty in SPY TLT. We could very easily now start breaking down in a few weeks, that is, and that will be the sign that we've been waiting for. We'll be watching these lows, which are matched here, and this trend line very carefully. We hope that it'll start going back up towards 2, fail there, and that will be your euphoria phase, people buying up to 25.25, 25.50, 25.60, and then a very, very brutal move down that will probably shake everybody, and it'll be a major, major event in the financial markets sometime in the next 2 or 3 months. This is a chart, a weekly chart of NQ, the Nasdaq 100, and while it's heading higher and probably heading for 6100, 6150 easily over the next 2 or 3 weeks, we have these huge divergences in the MACD. Another very, very worrying sign. We are about to either go much higher or break down because of this divergence. This divergence is now massive, and something is going to resolve it within the next month. One should naturally always have a backup plan, something which indicates that what you're expecting to happen is unlikely to happen, and this is a weekly chart of the dollar index. My way of thinking, the only thing that can prevent a significant stock market correction from the 2500s is a complete meltdown in the dollar, because that would actually make the denominator of the stock cheaper and therefore hold up stock prices. If now we went to somewhere around here, i.e. below 80, the likelihood is that the stock market would remain sustainably high, simply because the thing that you are paying for the stock in is so much devalued. Well, if that were to happen, we would need to first of all break the 50% retracement level at 91.37, which seems to be holding. Secondly, this trend line, which comes around 90, and then the 88.43 level, which is the 0.618 retracement. The market is very stretched on the downside. We are more likely than not to consolidate in this area, as I keep on saying, between, let's call it 94.30 and 90 for a significant period of time. That tells us that it's the stock market that's likely to correct as opposed to the dollar doing its work for it. But we will be watching this like hawks just in case it does start moving down very quickly, because that will actually prop up the stock market and make it go even higher than we anticipate now. We always, at big turning points, try to marry fundamentals and technicals. Well, the fundamentals are pretty clear. We are well over 17 and a half times forward earnings, which, as you can see, is an absolute record. For the whole market, we have really never averaged above 16 times for a sustained period of time. Therefore, we are more than comfortable enough to say that a return to 16 times forward earnings is nothing but a normal market reaction. If we look at the sectors, we will see some interesting things happening. This is consumer discretionary, i.e. XLY. It has remained stagnant and even began to fall slightly in terms of future expectations. That is why this market is having such difficulty going up, and every time SPY goes up it lags and therefore makes the chart that we showed you earlier. You can see how in 2007 it was the first indicator that something was very badly wrong, and the first one that took you out of the recession. Well, we are here. Where are we? We are here. So that is still the thing. Fundamentally, we have started turning over in XLY, and we will be watching this like hawks. If we look at the other sectors, consumer staples really crawling nowhere. Energy is now beginning to do its bounce, but we suspect that is people buying energy as an oversold sector that they can park their money in, as opposed to a big move that is expected. And finally, the financials. We are so rich. Almost everything that we can think of is discounted in the financials, that we just don't see it being able to provide that much more upside after this last 2 or 3% that it can go and push up SPY into the 25s, 25.50s. After that is done, we think it's just about completely exhausted in terms of XLF. And the XLV, we are just crawling along. The market is just getting more and more defensive here, buying XLV. And the industrials, well, we are very much at incredibly overbought levels as well in the industrials. The only thing that can save the industrials really is the dollar. If the dollar were to fall a lot, say 5 to 10% in the slight, at least, you would have a bigger push up in industrials, or certainly not a fall. And finally, information technology, which is still our favorite sector, because whatever happens, people will be buying technology. Even if the dollar were to fall a lot, people in the world will be buying even more technology, and certainly those companies have pricing power. Therefore, we think that this is the sector that's probably going to fall, have the biggest volatility, but when all is said and done, it'll be the one that holds up the best. Materials, very, very overbought, would not touch it with a stick. Real estate, very small sector and basically doing nothing. If anything, it's turning down. And telecommunications just can't get out of their way. This is another sector that we would like during a crash, because we think it would probably be very much a safe haven. And finally, utilities. It's very interesting that the utilities will just not come down, and that to us is yet another sign that people are uncomfortable buying growth stocks at this stage of the cycle. They prefer the safety of utilities and bonds. Therefore, we think that when the move comes, yes, utilities will certainly come down with them, but we think it'll be a major buy. You can see that the utilities very quickly reversed, and they will be a very major buy if they were to touch the 14 times multiple line. For everything that we have told you to be true, it would make sense that TLT is the market to watch. TLT is in a very clear uptrend. A break, which is not very far away, it would negate what we have told you. It is unlikely that the stock market would crash while TLT is being sold. TLT is a risk off asset, and therefore if TLT starts falling, it's a sign of risk on. We think it will touch this line. We think it'll definitely try to break, but that will be at a time of the highest euphoria in the stock market. So that line comes around somewhere around the 125.50 area, and it will be interesting to see if it holds. If TLT holds this area around 125, while the stock market is making new highs around 25.25, 25.50, we will be confident that we are set up for a major risk-off phase. And finally, a look at volatility. This is XIV, so the inverse of VXX, which makes much more charting sense. You can see that it is creating divergences on both the RSIs and on price. We are now at new highs and XIV is not at new highs. If we fail to make new highs in XIV when the market is going up to 25 plus, I think God help us. That will be probably the clearest indicator that a nasty vicious move down is coming, probably all the way down to I'd say the 50s. It will be a just a fantastic opportunity, and the one that we would think is the highest risk reward, simply because put options on the XIV are going to be very, very cheap. So for a very small outlay, you'll be able to have massive leverage and excellent risk reward. And that is what we'll be concentrating on in the next couple of weeks ahead. And the biases for next week, but really they're the biases for the next, call it a month. In the bond markets, we're looking for the start of a very volatile period. We showed you how that 125 level is going to be very key in TLT. Therefore, what we expect is volatility. From that 125 level, it's either going to go up towards 130 without batting an eyelid, or it's going to break down very substantially, in which case volatility in the bond market should pick up substantially over the course of the next couple of weeks. The same for European markets. And there should be a very measurable increase in volatility in the ES as well, simply because refuse to believe that the market is going to sell you long-term puts at very cheap levels below 11% volatility. That just does not make sense. If we see an increase in volatility as the market is rising, we will know that there is something very interesting taking place. Most of the euphoric action should actually take place in NQ. NQ should probably go up double in terms of percentage points of what ES goes up. So that will be our sort of euphoric indicator, and it might get all the way up to 6150. So we will be looking for that very closely. The Russell 2000, we are looking for it to be another leading indicator, so far as if it makes a lower high on this move, it'll be a very clear indication that something is very badly wrong. In terms of volatility, as we said, watch for a lower high in XIV. If that were to happen, we will be very big buyers of out of the money puts in XIV. It could be they will be very cheap. They're very cheap even now, but the risk reward in those is going to be massive. We still don't think that anything has changed in terms of super cycle. The emerging markets and other developed markets should outperform and continue to outperform the US. And in the DX, as we said, it keeps on closing below 93.60. The maximum we can see for a retracement is 95.07, but all the danger really is to the downside. The danger of a big move is to the downside, because if they see that the stock market, they cannot hold the stock market, they are likely to try and push the dollar lower and therefore prop it up using cheaper dollars. When all is said and done, volatility over the next month should start a measurable move higher in both fixed income and in equities, and probably the currencies as well. We could have some very interesting moves. This trade is to be added on any big move in SPY and XLK. If we are right and we do see some very big moves over the course of the next month or so, these relationships will hold at different times. So it'll be an ideal time to buy XLK on big drops and EEM on big drops, and then when there are big squeezes back up, to sell the SPY. But we will be tweeting all those moments to you starting Monday. We are anticipating a very interesting, not next week, but in 2 or 3 weeks' time, we're anticipating some very, very interesting price action. Thank you very much indeed, and speak to you from Monday on.